Joining me now is Art Hogan. He's the Chief Market Strategist at B. Riley Wealth Management. Art, welcome to the show.
Thanks so much for having me, Ashley.
Art, so what is your biggest takeaway from these inflation numbers this morning?
I think you set this up perfectly. I think the headline number came in a tick below expectations, which is good news. The core number came in a tick above expectations, which is not great news. The difference between the two is the core backs out energy prices, which actually helped keep the headline number in check. I think all of the things that drove the inflation, this particular report, are things that we expected to see. So think about apparel and furniture and select electronics, all the things that we know are feeling that tariff impact already. Couple that with some surprises. So we're seeing shelter costs come down more than it had been anticipated, and that's good news. I think that's been very sticky. Part of the core services was softer than expected. I don't think that was expected. But one of the surprises to me was we're already starting to see new car prices move up, and in the wake of that, used cars and trucks were up 4.8%. So that was the one thing that caught my eye. Away from all of that, I would say this is very much in line with expectations, and I don't think this changes the path for the Fed as it heads into a meeting in September where they'll likely cut rates at the next 3 meetings by 25 basis points.
Speaking of the Fed, as of earlier this morning, traders were pricing in a more than 80% chance that the Fed would cut rates in September. Can you talk a little bit more about that?
Yeah, so the big change in the last couple of weeks has been the jobs creation, right? The non-farm payroll number came out. It was below expectations, but worse yet, the revisions to the last 2 months took us from an average of creating 135,000 jobs a month down to 35,000 jobs a month. So clearly the Fed has enough evidence to try to defend their full employment mandate, and they likely start that process in September.
Art, in other news, the U.S. extended its tariff deadline with China another 90 days, and Nvidia and AMD have agreed to give the U.S. government 15% of the revenue from their chip sales to China. What is your take on this?
Yeah, both those stories would have moved markets yesterday if not for the anticipation of today's CPI. So I think the celebration for both those pieces of news, largely expected on China getting a further time out here before these things go into effect. I think that's positive. It's constructive. They're one of our largest trade partners. But I think the Nvidia AMD news actually caught markets by surprise, and I think, again, a real positive. What we need to hear from now, though, 2 of our top trading partners are still in limbo, and that's Mexico and Canada. So without those in the mix, we really are still in the fog of this trade war, getting closer to the exit on this trade war highway, but it's certainly going to need Mexico and Canada with some signed agreements or some frameworks of agreements to get us out of this trade war and onto other things that are more important.
And Art, how are investors weighing the White House's tariffs plan against the Fed potentially cutting rates, and what do you think is impacting sentiment more?
No, I'll tell you this. I think that when you think about tariffs, right, this is going to be it's obviously a tax. It's a tax that's largely placed on consumers, but that is a one-time event, right? So this is a price increase. This is not ongoing inflation caused by a lack of supply because of the supply chains breaking down. Clearly, that is coupled with the fact that it's going to slow economic growth. We're starting to see that in the labor market. So therefore, the Fed needs to defend the mandate that they actually can have some effect on, and that's full employment. So that's why the Fed will finally make a move in September for the first time. People have been waiting that for quite some time. I think there's enough evidence, both with today's inline CPI and last week's non-farm payroll number, for them to start cutting rates 25 basis points in September, October, and December.
And what sectors do you expect are going to spark the most market activity within this week, and why?
Well, I'll tell you this, if in fact we keep this 80% of folks believing that the Fed's going to start cutting rates, that's actually going to be good for small caps, which have underperformed all of the major indices, not just this year, but on a 3-year run rate. So I think this is a positive for small caps. Lower interest rates with steady economic growth. We're growing at about 1.25% in the first half of this year. That likely picks up a bit in the back half of this year.
All right, Art Hogan from B. Riley Wealth Management, thank you so much for joining us.